The Intelligent Investor. Full summary. The Intelligent Investor by Benjamin Graham is widely regarded as one of the greatest books ever written about investing. Although it was first published in 1949, its lessons remain just as valuable today because they focus on timeless principles rather than temporary market trends. Benjamin Graham teaches that successful investing is not about making quick profits or predicting the future. Instead, it is about making rational decisions, protecting your money from unnecessary risk, and allowing your investments to grow steadily over time. The book begins by explaining the important difference between investing and speculation. Graham says that many people believe they are investing when they are actually speculating. A true investment is one that is made only after careful analysis, provides a reasonable expectation of profit, and protects the investor's capital. Speculation, on the other hand, involves taking risks in the hope of earning quick profits. While speculation can sometimes lead to gains, it can also result in significant losses. Graham advises investors to recognize the difference and avoid confusing the two. One of the most memorable ideas in the book is the concept of Mr. Market. Graham asks readers to imagine the stock market as a business partner named Mr. Market. Every day, Mr. Market offers to buy your shares or sell you his shares at different prices. Some days he is extremely optimistic and offers very high prices. Other days he becomes fearful and offers very low prices. The intelligent investor understands that Mr. Market's emotions should not determine their own decisions. Instead of following the crowd, they take advantage of Mr. Market's emotional behavior by buying when prices are low and selling only when prices become unreasonable. Another major principle in the book is the idea of a margin of safety. Graham explains that investors should never pay the full estimated value of an investment. Instead, they should buy only when the price is significantly lower than the asset's true worth. This difference acts as a safety cushion in case the investor makes a mistake or unexpected events affect the business. A margin of safety reduces risk and increases the likelihood of long-term success. Benjamin Graham also divides investors into two categories: the defensive investor and the enterprising investor. The defensive investor prefers a simple, low-risk approach by investing in high-quality companies or diversified funds and holding them for many years. The enterprising investor is willing to spend more time researching businesses, studying financial statements, and searching for undervalued opportunities. Although the enterprising investor may earn higher returns, this strategy requires more knowledge, patience, and discipline. Throughout the book, Graham repeatedly emphasizes the importance of emotional control. He explains that fear and greed are the biggest enemies of successful investing. During market crashes, many people panic and sell their investments at low prices because they fear losing even more money. During periods of excitement, many investors become greedy and buy expensive stocks because they believe prices will continue to rise forever. Graham argues that intelligent investors avoid these emotional extremes. They remain calm, think independently, and base their decisions on facts rather than emotions. The book also highlights the importance of diversification. Graham explains that no investor can predict the future with complete accuracy. Even the best research cannot guarantee success every time. By spreading investments across different companies and industries, investors reduce the impact of any single investment performing poorly. Diversification helps protect wealth while allowing long-term growth.